Well, thank you, Marty. I appreciate it. This morning, we're speaking about alternative assets or alternative strategies. And we have as Marty had mentioned, we have an eclectic group of people up front here to talk on that topic. We have Sean Coe, who's seated right here. And Sean is a third generation family office with some investments in crypto and entertainment. It's going to be a fascinating conversation. Sitting to his right, we have Joe Price. He's a member with Mintz, the law firm here who's hosting. Thank you very much. His practices focus on debt financing, including bank financing. If you heard from just the last panel, there's going to be plenty to talk about in that space too. To my left, I have sitting very close to me, Charles Friedberg, co-founder and COO of an impact investment firm called Mobilize Capital Partners. And to the left of him is Eveline Gerck, who is an advisor for family offices, currently working with some venture funds. So we've got a bunch of different topics to cover here. My name is Mark Heil. I've been involved in the alternatives business since the mid-90s. So it's been a while. I've seen it from a bunch of different sides, including capital raising, marketing of funds, fund administration, and helping investors make investments through the retirement funds. So a lot in my background, a lot that I've seen. And Marty, as far as the anxiety factor around climate, I've lived through, I'd say about 4 or 5 of these. The world's coming to an end in 10 years. We're still here. It gets hyped up a little bit. It's like the weather. So I just tell everybody, keep it calm. We look forward to having a conversation, not only with the panelists up here, but with you out there. So if you have thoughts, comments, questions, don't hesitate to jump in and raise your hand and we'll get the microphone out to you. So with that, I've already given a kind of a very quick overview of our panelists. What I like to do now is start, I guess we'll start with Eveline here. Eveline, tell us about yourself. Give us a little bit on your background and what you're doing now, and tell us about the venture funds that you're involved with.
Hi, everybody. So my background, I started with, the big banks as investment analyst. Then I was an institutional investor rank for many years. Then I moved to private equity. Then I was a GP for 16 years. And then the past 4 or 5 years, I worked with family office called Office Square as a venture partner and also in the board of funds. Right now, I'm in the board of 2 funds, actively working with them. One is the K Fund, which is in the market right now for the 3rd fund. And the K Fund is a growth equity fund. So basically invest in companies that make life easier, but in the all tech driven, like SpaceX, Chewy, and some other companies in our platform, like Alfred, which is a prop tech company. So it's quite diversified and has had a return of 35%. And because of the strategy of going to late stage in growth equity investments, usually start returning the capital to the family offices in 4 years. Our investors are so far 100% of family offices. We started with a big family office called Andina Capital in Utah, backing the fund, and now we're in the 3rd fund in the market. We're half capitalized already, but we still have room. And the other thing we're doing now with the K Fund still, we have a prop tech investment in a company called Alfred. Our co-investments have had returns of 39%, and we still have this in the market until first 2 weeks of May. So if you guys are interested in any of those things, just reach out to me through LinkedIn or talk to me here now. The other fund that I'm on the board is a seed stage fund called Studio VC. We're not in the market with the 3rd fund yet, but we have like big unicorns like Wayflyer and investments that we got in when it was being priced at like 30 million and now is $1.7 billion valuation. So we have a big event tomorrow at the Classic Car Club in Manhattan. And if you guys want to come over and meet some of our companies and meet our investors and the team, also reach out to me. And that's about me.
Thanks. Charles Friedberg, despite my youthful appearance, almost 30 years in alternative asset management. I've been at firms like Angelo Gordon, Argent and Creek as a portfolio manager, co-founder, chief operating officer and president, and I'm in the process of launching a new private markets impact investment fund that will be exclusively for high net worth individuals through independent registered investment advisors. And we're not planning on launching until the end of the year, so I'm actually here just to answer any questions and participate, not selling anything today.
Well, I got one question.
Yeah, sure, go ahead.
There's impact funds, ESG,
Sure.
sustainable, that's emerging markets. Please distinguish among all of them.
Yeah, so first and foremost, ESG in our view has gotten somewhat overutilized. So the first thing in difference is a lot of ESG funds are focused on public markets. We're not. We're focused on private markets. In addition, all the investments that we will be pursuing will have not only a return KPI, but also an impact KPI that we'll be measuring against, and that will aggregate to a total portfolio of KPI. So I think, while ESG has gotten a lot of marketing play, what we're actually trying to do with our new firm is to have a real demonstrable impact on a transition to sustainable economy through private market investments that are tracked, again, both upon their impact to the economy as well as the return impact.
So you talked about sustainable, you talked about sustainable whether it's within the US or outside.
It'll be globally focused. So we're country agnostic, yeah.
Excellent. John?
Hello, everyone. Thank you for having me. Thank you, Marty. You've been a great friend for many years. My name is Sean Coe. I represent Koherent. That's our family office, third generation. We've made most of our wealth during paradigm shifts throughout historic events. My grandfather's generation was involved in modernizing South Korea after the Korean War. My parents' generation, my father was an accountant at Arthur Young when it merged with Ernst & Whinney during the disruption of the entire accounting industry from paper ledgers to computers. And then my uncle, my mom's younger brother, invented HDMI technology, which, as you know, really revolutionized content distribution. And my personal background, I was born and raised in New York. I went to Wharton, like Marty, he's my alum. But from a young age, I was involved in music. So I've developed a career in entertainment and was one of the first people to introduce Korean content like K-pop. And I'm sure you've seen, a lot of the rise of, different films and TV shows. I've been involved in helping that content spill over and arbitrage that into the US market. And also, I've worked with a lot of Asian institutions to place capital in the US. So I'm more on the buy side. Furthermore, following the footsteps of my uncle, in 2021, I patented a new algorithm called proof of reception. And just like my uncle has done with video to create a video standard, we've created a data standard. And today we live in a world where all of our personal values lie in some type of database. Our money lives in the banking network. We can also look at, music, securities, all these different values. And without being too technical, Joe, can you help me with a little demonstration? Can I give you this money here?
Yes.
Thank you for hosting us. That's a little bit of my rental fee for the seat. But essentially,
Good job. I will.
in order to understand this new algorithm called proof of reception, we have to realize that we're in a paradigm now where all of our personal values lie in some database online somewhere. And because of that, now we don't need to rely on third-party validators to validate the transaction. So let's say that you have that $10 in your bank account. I have a bank account as well. Our bank accounts discuss, they connect with one another through the ACH network and the SWIFT network. We all know that. And now let's say we have an asset. My family also owns Manhattan Woods Golf Club, so I brought a golf ball to represent asset. You can think of this as a security. You can think of this as music. You can think of it as an ESG metric like carbon credits. And now leveraging our algorithm and sending values within the banking network and within wherever this value is stored, the proof of reception algorithm says, once I receive your money, you receive my asset, that completes the proof of reception. And this might look like a primitive example, but this is how we can revolutionize a settlement in finance. So now you can not have third-party custodians where money can be transferred the beneficial owner upon that title being transferred to the person who invested. We're using it in entertainment, where celebrities can now transact directly with their fans. We have a big activation coming up for Eurovision in Europe with 150 million viewers, where we have the biggest singer in Ukraine offering her music via this process, where people can now pay for her song directly, and that money is going to her foundation to help rebuild cancer hospitals for children in Ukraine as well. So across all these different verticals, I don't want to be too long-winded here. We've created a true human-to-human relationship validation paradigm that gets rid of a lot of the traditional inefficiencies that have led us to the current kind of economic turmoil that we face today. So
Before you hand it over, I just want to be clear on proof perception that you spoke about.
Sure.
That is not a blockchain technology, right?
no, I mean, it's not a blockchain technology. It's just a data validation technology and a data standard. But some blockchains are using it because their traditional means of other validation have not been sustainable, as you've seen with the crypto markets.
Excellent.
Yep.
Thank you. Did you pass it down to Joe? And Joe?
Thanks. I do like golf, and I might have to keep that ball because Mark, did you really have to put me after Sean? It's very interesting. Thank you so much. I'm Joe Price. I'm a partner here at Mintz. It's great to see so many of you out there today at our brand new office space and conference center. Appreciate everyone coming so much. I'm a partner in the debt finance group at Mintz. So it's all corporate related, not real estate. It's a very interesting panel on real estate before, but that's not my subject area. One of our primary focuses here at Mintz is middle market private equity and family office representations. So my group will represent the sponsors and the family offices in connection with their leveraged buyouts, refinancings, restructurings, everything that has to do with the debt markets. And we're primarily focused on the middle market here, just to set the tone. And when it's my turn, I'll be talking about opportunities of family offices with respect to direct lending, as alternative lending has been such a hot topic, and it's taken over the market for the middle market over the past 15 years.
Yeah, and I think the last panel right before this touched on that a lot in the real estate space too. So what you're going to be adding to it, and you find it to the private equity venture, the other assets will be very interesting.
Thank you.
So, Sean, actually, I want to start with you. I'm interested in your family's investment strategy, how it's changed through the generations, and maybe you could just enlighten us a little bit about most important lessons you learned from the generations that went before you.
Sure. So I also go by ESCO, which stands for Every Situation Can Offer Hope. And that really kind of shares my mantra in terms of how I look at investments and what I've learned from my predecessors in my family. True entrepreneurs are the people that see hope in a hopeless situation. So I think, over the generations, we've seen business, not only as a means to enrich ourselves, but as a means to provide means for people that don't have, basic necessities. So we call it kind of business as a mission, and we're very mission oriented in what we do. We're not just chasing after money, we're chasing after value. And as a byproduct of that, we're able to create, very unique alpha, in certain areas that weren't traditionally asset classes that people go into. And being early movers in this space, like proof of reception, Asian content, emerging markets, disruptive technology, we are able to have that kind of, multi-decade growth, as these new economies grow, and as all, as the tide rises, all ships rise as well. So,
Excellent. Talk a little bit, if you just would, what are you looking at today? What type of deals are you looking for your family office?
Right now, I'm really trying to outbeat my uncle, with friendly competition to create a technology that really provides value for the world. I think the problems that we're facing, we can't put a Band-Aid on it. We talked about the real estate issues before. These are systematic issues. So it's really something that needs to be fixed from a infrastructure point of view. And if you can think of the world today, because we have this new algorithm, Now we can like plug in Asian liquidity into kind of New York distressed real estate and kind of get rid of the intermediaries that traditionally manipulated the human relationships that just wanted to, trade one asset for another. So I think for us, it's to kind of create this new infrastructure and allow people to thrive on top of it, because as other people benefit from it, the technology will also be more proliferated as well.
If you could hand that to Joe, because I'm going that direction.
Okay.
Joe, things, as we've already sort of touched on, this private credit market really came to light after the 2008 banking crisis and real estate crisis at that time. And a lot of it, as you heard in the previous panel, was pushed out from the banking system into the private fund structures. Talk to us a little bit about how that market has evolved through the years and
Sure.
maybe some of the more novel strategies you're starting to see today.
Happy to. Yeah. So, about 15 years ago, call it that. I think we were probably dealing more in the middle market with the traditional mainland banks, bigger financial institutions, and that's since shifted, as you noted. Now I would say the majority of our deal, almost the vast majority of our transactions that we're working on involve alternative lenders, direct debt funds. And, those can be, single lender transactions, or, we just did one, it's about 500 million a couple of weeks ago, where it was just a syndicate of alternative lenders. So when I say syndicate, it's more of a club. So, 5 to 6, I believe, made up that bank group there. So they've really taken over the market, call it shadow banking or alternative lending, debt funds, there's a lot of different names there. And I do think that, they've become a lot more institutionalized, right? As these institutions have done more deals and raised more capital, and, what their investors, right, are expecting in asset classes are a lot more narrow, right, than they probably ever were in the past. So I do think that as a result of that, a lot of family offices have some nice opportunities to be a direct lender, in this space. And, I, again, categorize it as, middle to lower middle market. And there's a couple buckets of opportunities I think that are out there really. And, the first one is, of course, distressed companies. Especially now we've seen a lot of portfolio companies that are just kind of stuck with their lenders, where, the business is going to be doing fine, not great. But, they're in a financial covenant default, for example, and the lender wants to force refinancing. And, often the first salvo to that is to do a forbearance agreement and then, force the company into a sale process. And, the company's fine. So they don't want that to be a change of control transaction. They think that their equity will be able to ride out whatever the current issues are. So I think there's an opportunity for family offices to purchase that debt, whether it's directly from those lenders or refinance it, as a whole. And, I wrote down a couple of things here, but, I think they can consider, also alternative liquidity, like subordinated and mezzanine structures, right? But, we've tried to introduce a couple deals and some of the more mezz focused lenders in the past don't do that anymore, right? I think the risk profile has changed. So, if there's any liquidity that's also necessary, right? A company has to do an add-on acquisition. The ability to bring in mezz debt, right, is something that I think is definitely out there. I think the family offices can be more nimble. With our representations, we've seen that, sometimes there's things like interest-only structures or PIK interest, minimal financial covenants, right? They're out more bespoke structures, as a whole.
Yeah, I think we're really, one of the things I've seen a lot in the past, 5-6 years has really been the bespoke structures that have happened, particularly in the secondary markets. That company we were talking about a minute ago, it's performing, but it's got a debt issue, right?
Correct.
So I've seen preferred shares. I've seen,
Yep.
different loans going in there to extend the time that the company has to perform and hits the marks and get it over the humps that it needs to achieve. I've seen all sorts of different ways that very creative from these lenders to get involved with these companies and develop a way forward. So that's
That's right, Mark. Yeah, I mean, I would add to that. I think it's also a unique opportunity for a family office to get under the hood with a company too, right? By providing non-dilutive capital, figuring out what's really going on there and, making some steady high yield type, returns in the meantime. Oftentimes you have board observation rights or even board seats that a lender in this space will take. So you have a unique opportunity to take a look, what's happening. And I do think that there's an underserved market, as well. We're often approached by smaller clients looking to source some debt and sort of that sub TTM, call it $5 million, EBITDA business, can't raise the capital from some of these, more established alternative lenders. And, they're able to, take investments from family offices.
terrific. Eveline, Tim Draper was here yesterday. He was the second most popular speaker they had here yesterday. He spoke about 4 areas he was excited about. One was, obviously AI and robotics, Web3, space, and I'm sorry, I forgot what the 4th was. So do you? See, I knew I could pick up on somebody. Was crypto? What was the 4th one?
Bitcoin.
Bitcoin. Okay.
Healthcare.
Decentralization. Okay. We'll start.
Robotics, Bitcoin, space transportation, healthcare.
Okay. So there we go. And then we had flying cars being buzzed around too. So what are the technologies, for your 2 funds? And one is the seed level, and this is great because we get the contrast here, right? Between the seed level, what are they looking at? And what is the larger fund looking at, the growth equity firm looking at?
So the seed stage looks at, similar technologies that Tim is looking at. Before I talk about that, I was just going back to what you're saying about lending and everything. I was amazed yesterday when he said that he was getting call from the portfolio companies that they needed to get funded. So I was wondering how he did that he got that from the reserve capital he had, and then he established like a loan for them. I mean, what's going on? I think that a lot of venture capital firms extended loans to the companies and they're probably charging. So we haven't done that, but I was, I was not here, but this is a question I was going to ask him, how he provided the capital to these companies. So in the seed stage level, we look at companies that basically are B2B, but we also are in media. We are invested in companies in like Wayflyer, which is a supply chain. We are invested also in companies like Bark, which is security, cybersecurity. So traditionally, what we look companies that we know that will make it, because at the end of the day, when you invest in seed stage, half of a portfolio can evaporate. It doesn't make it. So we have a portfolio now at 35 companies, and only 2 we kind of exit because they are not going to make it at par. So what I see that the most important criteria when we look at companies, like where are they, which problem they are solving, which industries they are focusing and making a disruption, and how successful are likely that they're going to be to make this change and eventually, IPO or being sold for a larger player. So the seed stage is a very long-term play. So you don't know if those companies, they can, fail 5 years from now. So usually the fund is 7 to 10 years when you're a seed, and you try to exit during that time. So when I believe it or not, I think the seed stage is a little bit less dangerous than if you go just comparing like to a private equity firm that has to get out in 5 to 7 years, because you're seeing those cycles being like bigger and bigger for you to recover. So I think that seed gives you a little bit more of, as a family office, like you can breathe and stay there as a individual that invests in funds like that. Now, the K fund is very different. They are very diversified. So it's just like Draper. We have SpaceX, we have Chewy, we have Grub Market, we have a couple of health tech companies. So we are across the spectrum. So we kind of have like one company in each sector that we know that the technology is going to solve a problem and improve people's lives. I keep saying like somehow we is an impact fund in the sense that we impact society, and all the companies that we are investing, they are going to impact society. So it's a much more diversified fund. And the way it is like that is because it started with basically serving one family office and now serves a lot of family offices. So the mentality is, okay, we're going to have alpha or the other way around. Like we want to preserve capital, but not at the expense of providing alpha. And the other thing that is very different is that the seed stage fund that has a more longer term, and the K funds is a strategy that they start returning your capital 4 years after you invest. So they look at companies that are going to IPO or are going to be exit somehow within the next 4 years. So the other difference is that we also, in the K fund, different from the seed stage, because of the nature of the stage of the companies, right, offers the co-investments in companies in the portfolio. So we offer co-investment in SpaceX in the past. Now we're offering a co-investment in Alfred. And as a family or individual, you can go into that co-investment, invest directly in the company, and stay as long as you want. So those are total different strategies. Like one is very, very long term. The other one is a little faster, but not at the expense of the IRRs.
Okay, but in terms of what you're investing in, they
Yeah.
technology areas or the domains or the.
So again, the K fund is investing in technology that makes lives better. So we are investing in companies that we have a crypto company, so it has blockchain. We have SpaceX, which is space. We have Grub Market, which is delivering groceries. We have health tech. We have Chewy. So it's very diversified.
How about your seed fund?
The seed fund is very tech driven. So they're looking for disruptive technology that are really going to change, an industry. Like Wayflyer did with supply chain, and then they did really well during the pandemic. Because what Wayflyer does is manages all the flow, help the small companies that work, let's say, with Amazon or any distribution company. All those suppliers during COVID, for instance, they had all those orders. And how do you move all this stuff around with all the supply chain problems that they had? So they finance those companies, they help those little players to go and all over the world and ship all this, all the goods. And this was a disruptive player that really got accelerated by COVID. So, but even if COVID hadn't happened, it would be a disruptive player. So Bark is a company that, for instance, is cybersecurity for kids. So all your kids, they go into, primarily during COVID also did really well because everybody went remote, and you have all those hackers trying to get to kids, and Bark was protecting the kids. So that's basically, one fund is more disruptive driven technologies. The other one are companies that we know they're going to be doing really well in 4 years, and we can give you a very healthy IRR in that short period of time.
Fantastic. Thank you. Charles, I'm going to switch over to you. I'm sorry, you had a question? Sorry, I thought I heard somebody.
No.
Apologies. Charles, let's talk about where you see the opportunities for the investors that you're bringing into your fund. And again, your strategy is an impact fund globally throughout the world. So, and you're approaching wealth managers to try to get investors in. Is there a certain segment you're looking at? Is this going to be a domain play like within healthcare, or is this going to be? And I don't want to you're giving away your secret sauce here.
Yeah, no, it's fine. It's a little early for us that we're still putting this together. We do have a cohesive strategy and partners and all of that. And so I'm happy to discuss that. I think though, and I'll get to that, but I think maybe something that I thought would be interesting for the audience is reflect something, that was talked about before, which is everyone's talking about alternative finance right now. Back in 2008, when I was at Angelo Gordon, I would argue that alternative and alternative finance actually meant something. Today, I think you make the point. Alternative finance today is a marketing moniker, in my perspective. The vast majority of alternative finance today, I would argue, is a cyclical bet. It's determining when the banks are pulling back, and that's an opportunity for the alternative finance folks to come in. And I would argue that if you're making a consideration for alternative finance, the real insight is the alternative returns in alternative finance are not so much through going through the institutional investors that have grown up now over the last 15 years, but rather those that structurally can pull out the revenue streams or the return streams that are in fact, quote, alternative. So I think when people talk about alternative finance, which is a very hot topic today, you are making a cyclical bet, in my view, in 90 to 95% of the time. To get an alternative stream of return, that is a different bet. That is a different opportunity. Yeah, Marty, go ahead.
You know, it's super intriguing discussion on alternative finance because duration matters so much.
Sure.
You're saying a cyclical bets. What that means to me is that if I've got a shorter duration, it's less likely I'm going to get caught in down cycles.
Yeah, I mean, duration is certainly a component of that. But for example, there was a conference a few months ago where the GP of TPVG, which is a venture debt publicly traded BDC, was on there, and he was talking about how his, now they're not doing anything without a 12 handle. That's an interesting rate of return today. 6 months ago, that was a 7 handle on mezz debt. Is that alternative finance? Is that alternative lending? Is that an alternative stream of returns? I would argue probably not. Is 12% alternative stream of returns today? No, I would say it's better than it was 6 months ago, but I wouldn't call, and again, the reason I'm bringing this is just the topic of the conversation, which is alternative investments. And alternative finance is a very hot topic. So that's just my 2 cents on that, which is most alternative finance today is institutional, and it is not at all what it was 15 years ago. So I don't.
Yeah, I just want to mention one other thing. I mean, our group has always been, really focused on alpha generation, and I think what you're saying is that institutional alternative finance is not alpha.
I think very little of it is. It's a cyclical bet today. If you look at the vast majority that are raising capital today, there are still a spread business. It's not an absolute return business. Back in the day, alternative investing was absolute return focused, not spread focused. So I think that's something to consider.
No, I was just going to comment and sort of chime in on Marty's thing. So the party on the left is now the party on the right, as the who would say back in the day.
But anytime something starts as alternative and attracts capital, right? Institutional investors are going to come in. There's going to be there's going to be a growing up process. Yeah. Sorry, go ahead. Question.
I mean, so you're saying private debt is not alternative finance, alternative?
Well, last I checked, private debt has raised how many hundreds of billions of dollars over the last couple of months? If you look at the major bulge players that are out there, Angelo Gordon, KKR, they all have private debt funds that have raised over $100 billion over the last 6 months. Is that an alternative strategy? Are you unique in that strategy? I would say most likely not. That's a cyclical bet. That is the banks pulling back. That is economic hardships. That is companies that have fewer people to go to get refinanced. There's a huge wave of money that's going to that. You consider that alternative when every major endowment and pension fund in the country is putting money into those spaces? You can have a debate on that. My view is that that's not alternative. It's a cyclical bet.
Of a new asset class that was created after 2008. And as a matter of fact, KKR would tell you that, Carlyle has made more money on private debt than they have on private equity. If you consider
in a rear view mirror, totally agree. But you're not investing in a rear view mirror. You're investing from here on out. So it's 2023, not 2008. And in 2023, when Angelo Gordon raised the TALF and TARP funds, those were billions of dollars, not tens of billions of dollars. Right? It's a big difference. After 15 years of, quote, the private debt markets being created for alternative finance, today, with what you have, you have hundreds and hundreds and hundreds of options. Back in the day, you did not have those options. So I'll get to it. I would argue that alternative credit in and of itself is more marketing than it is actually an alternative asset class. But that's just my view. Yeah.
But, you're engaging in a little bit of semantic juggling here. Alternative in the old days was essentially something that wasn't in the open market, stocks and bonds, et cetera, et cetera.
Agreed.
So it had to do with anything that was off market.
Off the run.
Yeah. So
agreed.
if you retain that definition, then certainly private credit is alternative still.
Is private credit off the run at this point?
Oh, no, I'm just saying.
It's accessible in,
An alternative as not public stock and bonds,
you can invest in
and
alternative.
then alternative remains as a definition.
So there are private credit mutual funds, there are private credit interval funds, there are
The
private.
size
credit-
is immaterial. I'm just saying the semantics.
No, but it gets to accessibility.
Yeah.
Right. So if it's off the run, it's inaccessible. If I can invest in a KKR or a BlackRock or a Blackstone mutual fund, interval fund, is that off the run?
No, it's not off the run, but.
Then I would argue that if you keep
It's
the same,
alternative in the old definition.
well, I would argue it's not alternative in the old definition because it's no longer off the run. If anybody can get access to it, it's no longer off the run.
It's not quoted.
Okay, I think we need to move on.
It is in a mutual fund.
No, they're not in mutual funds. The private debt is not in mutual funds because they're not priced. And
There is a percentage of every mutual fund that can be in privates,
Yeah,
interval
very
funds,
few of
interval
them-
funds as well, which are
few of
priced.
them are accepting investments for their rating.
Again, this is just this is the topic of alternatives, right? What is alternative? I would make the argument that today, alternative private credit is not nearly as alternative as it maybe was back in 2008. Now,
Okay.
structurally,
Okay, can I
Let's have her.
just ask a quick question in terms of a to-do people here today? as
Sure.
An action step, since your fund's not available.
no,
Venture
here's something.
debt. Venture debt is positioned as a very good investment. Now, Hercules Capital
Hmm.
is in venture debt. They've had almost no defaults.
Yep.
Their stock is attractive and it has about a 12% dividend yield and you can write covered calls.
Yeah.
Why can't we just do that tomorrow and not go buy treasury bills? What's wrong with that strategy as an alternative strategy right now?
I don't think there's anything wrong with that as an alternative strategy. And
Okay, so you recommend doing that?
Well, I'm not in the recommending individual stock business. So if you're asking me a question, is that a viable alternative strategy? 100%.
Thank you.
And they're not the only ones, by the way. There's a ton of BDCs out there right now. TPVG is one of them where yields are in the mid-teens. Some of them are approaching 20%. TPVG is well-known Triple Point Ventures. There's a number of BDCs where the yields are currently approaching mid-teens.
Well, I just have to say that I don't think it's just a matter of being off the run. It has to generate alpha.
That is the argument,
And I
right?
will say that the overwhelming majority of wirehouse deals
Mhm.
don't generate alpha. It's just the nature of things.
So I guess it's not just alpha, right? Traditional strategies also historically have argued that if you're an active manager, you should be delivering alpha. It's the magnitude of the alpha. And is the alpha highly correlated to underlying market movement and whatnot? To me, alternatives are uncorrelated or historically have actually been uncorrelated, right? And you can make money, right? That was the old A.W. Jones model. I'm going to make money irrespective of whether or not the market goes up or down. Now, I would argue that again, most private debt today is a spread business. It may be better spread than it was a while ago, but it's still just a spread business. I don't consider, if you go into Angela Gordon's funds today, again, amazing firm. I worked there for almost 10 years. It's a spread business. It's not make money necessarily irrespective of what goes on in the marketplace.
It's interesting that you're making this argument because I would say that the route you're taking to raise your fund,
Yeah.
going out to,
Totally different. Totally different. Yeah.
well, the route you're going out to raise your fund was something that wasn't even, 5 or 6 years ago, going out to wealth managers.
That's right.
It really wasn't that viable to do. But today you see, even the KKRs and everybody
Sure.
now with their arms and their investor services servicing the wealth management business. So
Yeah.
talk about that development, and how you plan to attack that and how you plan to move.
Well, generally speaking, the independent RIA industry faces a number of challenges. One obviously is getting access to unique product. The second is, how to retain their clients from generation to generation. And the third is how to grow with, the KKRs and the wealth managers coming into the space. And so what we plan on doing is providing a platform that enables our partners to do all of that. Accessing unique product, most of the time registered investment advisors can't bring together, aggregate enough capital to have not only an impact, but to have influence over the investment managers with whom, or the direct investments that they invest in. Our model is going to enable an exponential increase in the influence that dollar has. And then access.
Does that put more risk onto the advisors?
No, we think it's less because one of the things that advisors never get on a lot of these private investments is transparency. And so we're providing. Right. We are partnering with the RIA so that they ensure that they have the information to engage and retain their clients.
Gotcha.
No channel, white labels, understand.
What's that?
Sorry?
I wanted to make a comment here.
Yeah, sure.
So two things very quick because I know we don't have a lot of time and maybe, also he can say something about that. Well, number one, the reason that you have all these huge private credit being offered now by KKR, Carlyle, and Blackstone is because they were big in buyouts. And with the interest rates going up, you cannot make the same money you were making before in buyout. So when they look at the private equity, and private equity is really hard right now. You have to do like value creation, which is really hard to do and takes a long time. Well, I'm just saying why they move that way. So if it's going to be cyclical or not. But I agree with him. Alternative investments were anything that was like different. So it started like with hedge funds, then you came private equities. Within private equities, you had venture capital. Within venture capital, then you have venture debt, then you have private debt. So I don't know a lot about that. I think that, our friend there at the end of the table can talk about that. Now, just going back then to the impact fund that you have right now. When we look at impact, it started with ESG, environment, social, and corporate governance. So now then they have like the clean tech, and now you have the carbon footprint. So it has been detached, the ESG, in a number of, and then you have like a racial, and then you have like gender equality. So what's going to happen with impact is going to have all those different segments, like is happening has happened with any other industry. So ESG by itself, it's just a term that it has disappeared. So I think that your fund and any other fund, either have like a couple of impact or 2, 3, 4, 5, or specialize in one. Is going to be really hard. I know like clean tech funds that are doing extremely well, but they just focus on clean tech. So I don't know if it's just impact, what the impact is going to be.
Yeah, I think we're going to stay away from the topic of impact because the fund hasn't been launched yet.
Yeah, I would also argue, ESG is marketing. I mean, ESG is marketing. More than actual demonstrable tracking of whatever impact, whether it's on clean tech or sustainable it is. It's a way to market as a quote clean or environmentally friendly.
At least in the public equity.
Yeah, I mean it's very different. Impact investing, and again, at some point in time, I'm be comfortable talking more about this. Impact is how do you not only have a measurable economic benefit, because it has to be self-sustaining, but how do you have a measurable impact on whatever the social engagement is, whether it is eliminating carbon from the atmosphere and so forth and so on, whether it's production of clean water and delivery of that to someone, whatever that is, there needs to be a KPI around the impact investment, which is lacking from ESG today.
Thank you. We have to move quickly here. Sean, I want to come to you, and then Joe, I want to go to you. So this is going to be the lightning round here, okay?
Okay, I'll wrap it quickly.
So one of the things I wanted to ask you is you obviously, we didn't talk about it a lot, but you on our prep call, you spoke about crypto. And then you also spoke about the entertainment field as an area that your family has been involved in. And I sort of view that as an alternative strategy. Talk about your interest in those and where you think they're going.
Yeah, definitely. I mean, even before K-pop or K-dramas or K-beauty was popular, we were able to secure a lot of rights in South Korea. I don't know if you watched the movie Squid Games, but the writer of that content, was literally a starving artist. He, had to sell his laptop after he wrote the script because he couldn't buy food. So, that's kind of when you're traveling, and going between these dislocated markets, and you have the proprietary pipeline to commercialize things, that's the opportunities that we find. One last thing I want to share about proof of reception before I say goodbye is right now we've gotten a lot of our early licensing revenue from companies that don't want to deal with data compliance regulations. So if you have a consumer user base, it can cost up to $30 million to validate their data and store their data. With our algorithm, customers self-validate the transactions. So companies are saving, a lot of money on those costs. And, we continue to kind of grow this new paradigm, but it was great being here today. And I'll hand it off to Joe for the grand finale.
Thank you, Sean.
Just sort of chime in on Evelyn's comments that she made just a minute ago and give your reaction to that.
Could you reiterate that? Honestly, we're having a sidebar here. Yeah.
It's all right. You know, it was the whole conversation about the evolution of the credit markets and the debt markets, the lending, and when does it stop being, you know, when does it stop being an alternative strategy?
Right. Right. Yeah. There's a lot of, debates that have been going on here. That's for sure. So, I mean, I think, yeah, clearly, more alternative is, outside of this, established, services that we have now and, looking for folks like, family offices. I mean, I think there could be great returns. Right. I mean, if, you're getting 12% at Hercules, a family office is probably lending out money for 18 to 20% and more, taking warrants, taking equity, it could be a pretty rich deal.
Yeah, and I think that's a lot, the equity kickers that you can get as a family office and things of that nature. Plus, I think there are nuanced areas that even a KKR just would find too small for them or, things of that nature,
Absolutely.
which would be interesting to a family office, but maybe not to a larger entity.
That's right. Thank you.
Excellent. Well, I want to thank our panel. I thought it was a great discussion up here, and I thank you, Marty, for this time.